Kenya's retail sector has been experiencing serious challenges that has seen two of the major supermarkets, that's Nakumatt and Uchumi, closing shop in different malls that has lowered the footprint in these malls. I'm here with the CEO of Deacons East Africa, Mushiri Wahoma, to shed light on how this has affected their business. Thank you for having us today.
Karibu to Deacons.
Okay.
Yes.
Okay, so today we just wanted to speak about what has been going on in the retail sector. How has your business been ever since?
Generally, if we talk about the retail space, the year just passed, that's 2017, obviously was a very, very difficult year for retailers because of a number of factors. Primarily, obviously, the election cycle gave a big challenge to retailers, just from a disruption perspective. And secondly, consumer confidence. People held back their spending needs and kept very, very calm. So we did see footfall and demand very, very suppressed. There were other factors, obviously one that you mentioned, the collapse of anchor tenants in shopping malls. So other retailers within those facilities obviously witnessed very significant challenges relative to foot traffic into those malls. And indeed, that is complicated by the increase in the amount of retail property space in malls generally. And this has led to cannibalization, such that customers are now having more choice to move around into various locations, thereby basically occasioning cannibalization. So it was a very, very tough year. We estimate that on the average we lost under 100 days of trading due to frustrations when people were mobilized onto the streets, etc., etc. But on the back of that, the year has started fairly confidently, although Christmas was shy of previous years. We are seeing 2018 looking up, and I think it will consolidate and come back to normal.
All right. Yeah. You sold one of your brands back to its previous owner. Maybe you could tell us why that decision was made and how it has affected your business.
Significant development for Deacons, because Mr. Price is a significant contributor to the overall performance of Deacons. And as you know, franchise arrangements are term arrangements. The franchise agreement was coming to term 2020, and therefore with Mr. Price's want to move more directly into the market, the directors of the business decided to take that option in order to divest out of that brand and develop its own brands and invest in other brands that are of relevance into the market. So it's really a natural progression of business. If you remember, 4 years ago, we had the Woolworths business. We also divested out of that. So it's an ongoing process of building brands, selling off assets in order to bring in other brands that are in the market.
All right. Talk about bringing other brands. What are other brands that we're expecting in this new year? What are you investing in?
I think it's going to be a quiet year for Deacons relative to bringing new brands. We've already just brought the FNF Tesco brand. That's doing extremely well. We want to focus on developing that into a solid footprint across the East African region. And there has been a strategic decision to develop further the Deacons brand itself, bring it back to market. So really a year of consolidation in reorganizing the brand portfolio of the business in order to have a more stable revenue stream from those brands.
All right. I'm keen into finding out how the gym equipment has been doing.
That's also been an excellent growth path. You've seen the amount of gated communities, the amount of hotels that are in build mode, and all these facilities require gym facilities for those who live within those gated communities and those who patronize hotel gyms. So that's gone extremely well. We've also seen a high number of high net worth individuals installing gyms in their homes. So we are certainly seeing growths of 20% plus in that particular environment.
You closed the TRM branch, first of all.
Yes.
Maybe you could tell us more about why that happened and how much you've lost in terms of the 100 days of not working last year, and as well as the footprint going down in different malls.
Well, it can be quantified in many ways. I mean, we traded with more stores. We traded down on the previous year, that's 2016. We traded down about 35-40%. So that immediately shows you where the challenge was with revenues. We are, as we said, in a consolidating environment. So there are some stores that we have decided to close. We did close one store at Thika Road Mall, relocated one. We are going to close one store at the Junction, the Baby Shop store. This is all in an effort to consolidate the portfolio of brands that we have, ensuring that each store that we have does meet the returns that we require. So this is an ongoing process. There will be a couple of store closures of discount stores that we have, just to make sure that we are ready to meet the consumer demand that is available to us.
All right. How many stores are you looking at this year?
In terms of closure, about 4 stores. Yeah.
Maybe you can name them.
Well, we're converting one Angelo store at the Junction into an F&F store. We're closing the Baby Shop store at the Junction. We're closing the 4U2 store at Capital Center, and we will be closing a discount store that is at Thika Road Mall.
All right. This is in line with your ongoing
reorganization. Yeah, it's reorganization, looking at the cost base, understanding what customers are looking for. I must say that competition is on the up. New brands are coming to market, so we have to respond to those requirements. Okay,
let's talk about competition. The last time we spoke, you told me that you were going to open an online store.
Yes.
Investing significantly in that area. Maybe you could let us know how far that has gone.
Yes, we are in an advanced stage, working out the logistical program to support an e-commerce platform. We've had significant breakthrough, and we are confident that in anything between 10 to 12 weeks, we should go live with an e-commerce platform.
All right. How will that e-commerce platform be like?
E-commerce is interesting because, in fact, in today's media, you see that African e-commerce platforms are still struggling. Yeah. So from a revenue perspective, we hope, of course, that will be on the grow. We did 2 million shillings last year through Jumia. We think we can take that up to about 10 million shillings within this particular year, so good growth, but not significant yet. What we're finding is that unless you have an e-commerce platform, then you're unable to actually market to the upcoming middle class, the younger 18 to 24, because they're consuming all their marketing material online, and therefore even if they're not shopping it online, they're at least consuming the brands online, and you must therefore have a presence online. So right now the bigger push is to have product online so that the younger people can see it online, and then even if not trade on the e-commerce platform, convert them to go and shop at the brick and mortar.
What is next for Deacons?
Well, for Deacons, like I said, it's going to be a consolidating year. It's going to be trying to get our ducks in a row and ensure that our customers are kept happy and engaged. I think around the retail space, we're watching the malls themselves, because they are the big drivers of middle class spending. We need to let them settle, because the amount of mall space that has come to market suggests that malls will also sort of generate themselves into various product offerings. So malls right now look very homogeneous, and that's not very good for the customer. So malls that will be able to differentiate themselves in the marketplace will probably do much better than other malls. Until that happens, then we're going to watch that space to make sure that any opportunities that are available, we clearly understand and can take them up.
All right. Do you feel like Kenya, especially Nairobi, has the malls are oversaturated?
I don't know that it's oversaturation. I think it's the ability to differentiate the mall product itself, because when you go to other cities around the world, you know that that mall is anchored by entertainment, that mall is anchored by fashion, that mall is anchored by food, etc., etc. I think here what we are finding is that you get the same offering across all of them, and therefore they look like they're too many. But I know, and I'm working with most of the malls in trying to push the differentiation of each mall so that customers do understand what offering they're getting out of malls. So in terms of oversupply of retail space, well, that's market driven. The malls who will be unable to let out space will naturally take a back seat.
All right. Thank you so much for having us.
No, thank you. Thank you for coming through.